Right, lads and ladies, today we're going to jump into market fractility. Nice, quick, and easy video to understand, eh? Right, so what is it? Introduction. In financial markets, the concept of fractility refers to the idea that price movements display themselves similarly across different time frames. What this means is that price behavior on one scale, such as the 5-minute chart, can be similar or even mirror the price behavior on a larger time scale, such as the 4-hour chart, daily chart, or even weekly charts. This fractal nature of the market provides valuable insights for traders, allowing them to better understand their trends and how to identify profitable opportunities. The concept of fractals in the market is rooted in the idea that market patterns like trends and retracements repeat themselves across various time frames. The key to understanding fractality in trading lies in recognizing that the same patterns occur across small time frames, for example, the 5-minute, and can occur on larger time frames as well. For example, this is important. For example, the short-term downtrend on the 1 hour could just be a retracement or a temporary pullback on a larger time frame, and that is still intact on the daily. Likewise, a small uptrend on the 15-minute could be a micro trend within a larger downtrend on the 4-hour chart. These fractal patterns allow traders to make informed decisions about potential entries and exits in the markets. All it means is that the same thing, pretty much the same thing, happens across every time frame. So whether it be your fair value gaps, order blocks, equilibrium, whatever it may be, your RSIs, everything works the same way across different time frames. And the most important part is the market structure. I'm just going to touch on it here, but you can look through this in your own time. So the most important thing is market structure. So when the market's making higher highs and higher lows, if we're looking at a market, we're going to have a look now in a minute. When we're looking at a market and it's making higher highs and higher lows consecutively, what does that mean? We're in a bullish trend. We're in an uptrend. And if it's making lower highs and lower lows, that means we're in a bear trend. But say, for example, on the 4-hour, we have your higher high, higher low, higher high, higher low, higher high. For every retracement here that we have on a 60-minute chart or a 1-hour chart, credit to Donny for the cheat sheets. For every 4-hour chart, a retracement on a 1 hour is going to be made up of 4 candles. It's going to be made up of more than that, 8, and more again, whatever the math is, 15-minute candles. So that gives us opportunities to get a sell in if we can identify this higher high, and we can identify that we need to create a lower high on the a higher low on the 4-hour time frame. Well, then that gives us an opportunity to scalp or take a short-term trend trade against the overall trend and still profit from it. Now, once we're aware that that's what we're doing, once we don't think that we're going to short this here and it's going to go all the way down, once we're aware that the overall trend is bullish, but the short-term trend might be bearish, allowing us to catch a little retracement trade within here. Yeah, when looking at market structure, for example, the time frames, the daily time frame, if we were bullish on the daily, we can anticipate higher highs and higher lows on both the daily and the 4-hour time frame. But if and when the 4-hour time frame has breaks, this will indicate a daily retracement or the start of a new expansion. So you can see here, your blue line is going to be your 4-hour. So for every daily high and low, you have so many opportunities to catch up and down trades, bullish and bearish trades, shorts and longs, whatever you want to call them. So overall, you do want to be trading in line with the trend. The trend is your friend, but it's important to note that you can take these shorter term trends against the trade, trades against the trend, and still be profitable. A good way of looking at it is a piece of broccoli. It's a big tree made up of little trees. It all's part of the one thing, though. It's all part of the one thing. So let's jump into the markets here now. We'll have a look. Right. Bang. We go GU for a change. Right, so let's look at the daily time frame. Actually, I hope we get rid of them altogether. So you can see for this section here, we can see that the chart is making higher highs and higher lows. Simple as that. That's on a daily time frame. Now, if we jump to a 4-hour time frame, look at the opportunities that we get to take, although we would be taking bullish trades. And as you can see, if we were to take a bear trade or sell, they're often always smaller than the expansions. Your retracements are always going to be smaller than your expansions. So that's just how it works. But you see the opportunity that you have to get maybe, although the overall trend is bullish, you have an opportunity to get a sell in here. You have an opportunity to get a sell in here, fill this imbalance, catch the leg up, catch a sell here to the other next higher high. So although the overall trend is bullish, within that bullish trend, we have the opportunity to take shorter term trends, which allows us to capitalize on every movement, every price movement in the market. That's a bit of a dodgy drawing, but you get the gist. And that's really as simple as it is. That is really as simple as it is. And now if we jump to a 5-minute time frame, you can see the same thing over and over. You can catch this sell, to catch this buy. Higher highs and higher lows, they're created amongst all time frames. You can drop to the 1 minute, not the 14-minute, the 1 minute. That point not available. Well, it's because I'm in replay mode. Turn that off. Fine. Same thing, you can see consecutively the same higher highs and higher lows being created. Liquidity sweeps, order blocks, fair value gaps, everything. And I'm nearly sure that you might even be able to go lower than this again. Yeah, 30 seconds. Can we get 30-second chart? Yep. Oh no, we can only get the minute chart. That's all it. You get the idea though. The same thing happens across multiple time frames all the time, every day, every second. So why is this important for us to know now as well? It's because depending on what sort of trader you are and depending on what sort of time frame you're looking at your charts, if you're looking at a 4-hour or a daily chart, and that's where you're getting your confluences and that's where you're looking for your breaks and that's where you're looking for your structure. But then it's important to note that the trades are going to take much longer to play out, which is fine. That's fair enough if you're a day trader, if that's the way you want to trade, or a swing trader. That's fine. But maybe if you're looking to get in and out of a trade, like I know people that trade MES, which is just a futures contract there. That's actually a bit messy. So we go. Yeah, people that would trade these futures contracts, they usually trade 5, 3, 1 minute time frames. So they'd usually do their analysis on a 15, maybe a 30, get some confluence as highs and lows off an hour, and then drop to a 5, 3, and a 1 minute to take their entry. And that means that they're in and out of the trades fairly quickly. So that's fine. So it's just important to notice that although you can take counter trend trades, it's important that when you're doing it, that you understand that it's in line with an overall bias. It's in line with an overall trend. So that's market fractility. It's that easy. Jump to your chart, have a look at it, understand it, go up market your higher highs, your higher lows, and your breaks structure on your daily and your weekly, and then see how the candles react in order to make those higher highs, and especially to make those retracements. Go have a look through it. Do a bit of homework. Like I said before, there's no point in coming here, watching me do these videos, and leaving it at that and thinking that's it. Now I know everything I need to know, because that isn't the case. But with that, we'll see you in the next video.